Hello and welcome to DNB and this market update in light of the situation in the Middle East. My name is Marius Brunehaugen, and with me in the studio is Torje Gunnarsson, who is the head of tactical active allocation here at DNB. So first of all, welcome back to the studio, Torje. Thank
you. Thank you for
having me. It is the case that if the markets behave somewhat exemplarily, you are basically here twice a year to update the customers in January and August. But now with the Iran war entering its third week, the range of outcomes seems to be large, and we have important drivers like both technology but not least energy, which is becoming increasingly stressed. And I emphasize stressed because we are still not at the point where there is panic across the board. That's right.
We are not
there yet.
But
as we stand here, it is Thursday, March 19th. The time has passed 10. As I said, we have soon put 3 weeks behind us in Iran. And we are still at the point where it is escalating. And an important change in the last 24 hours is that we have now reached the point where oil and gas infrastructure is being attacked from both sides. So that increases the severity. So potentially we are entering a new phase in the war with more permanent destruction of oil and gas infrastructure in the Middle East. So what does that mean? Well, it means that we could have higher prices for a longer period of time. And just today we see a significant increase in European gas prices also further out on the curve. So this is the backdrop. So what we are going to do today is to get your view on how to deal with this situation, how to think smartly about the portfolio, and not just get stuck in, call it what is happening here and now, but try to look ahead and see this in the long run. And then I just want to emphasize one more thing, the disclaimer: war and suffering is wrong in every way, right? When we talk about this today, it is from an economic perspective, which is our job. And then I want
you to please kindly...
Torje, could you just briefly start by reminding us what your mandate is? Because that is also important, especially for all the investors who are listening to you.
So I lead a group called Tactical Allocation. And what does that mean? It means that we manage portfolios, usually stocks and bonds, and then we try to be invested in the parts of the bond market we like best and the parts of the stock market we like best. Both are global. So typically we sit and think about how many technology stocks we should have, how many Norwegian stocks we should have. And in the bond part of the portfolio, we think about how many high yield bonds versus, for example, money market funds or something like that. And then we mix this together. And what forms the background for the mix is often macro considerations and perhaps geopolitical factors like what we are experiencing now. So that is the mandate. So we don't look at individual companies. We put together the portfolio, and then there is a colleague of mine who manages individual funds and picks individual companies. But we have the mandate to put together the portfolio and make changes based on what we think is sensible.
And simply put, you manage a very substantial amount on behalf of our valued clients.
So
to get this right, we have to start with where we're coming from. And we can just go back to when you and I stood here together in January, because then we talked about this good, what shall we say, Goldilocks backdrop from the macro side and the economy, and we talked about AI.
Yes, so I have a slide here with some other points. So Goldilocks, just to translate what that is, it's like a climate where inflation is moderate and perhaps declining, which was the situation we've been in for part of the year, where there were expectations that the central bank would cut interest rates. And at the same time, growth was good and maybe even rising slightly. It's like the best climate for stocks. So most people perceived it as positive at the start of the year. And it started off very well too. And you also saw that what did well in the market were the things that are more risky. For example, emerging markets, small and medium-sized companies, and so on and so forth. There were still some trends that I thought maybe we should talk a bit about, because one of the most popular investments in recent years has been in technology stocks. But we see that the steam had run out a bit there afterwards, after that turbulence in October and November of last year. Technology stocks have been flatter, but under the hood, a lot has happened.
So
there's a small figure later just to show what's happening there. Because AI is coming with full force, everyone's wondering what the big impact will be. And this has started to translate into major changes in the stock market as well. But now, as we stand here now, we're back and have on the agenda something very few of us working in the market have actually experienced. And that's stagflation fear. And what is that? It's a situation where you might not have a recession, but you have weaker growth while prices rise more. And where you might even need higher interest rates in a situation where demand is actually starting to dampen. It's incredibly rare throughout history, but we had it in the 70s, the last time we had an oil crisis. So it's something for many to think about, because we were then in in a Goldilocks situation, and then this happens in the Middle East, and everyone has to rethink. And that has led to high market volatility and a major rotation in portfolios. Because now some risk is being taken off the table. It's been interesting to see, for example, in what's happening now. The gold price hasn't skyrocketed during this period. It went up a lot before, but now it hasn't. So it's a sign that many are uncertain, and many are taking money out of the market too, rather than just rotating. So that's where we are now. And what's happening now is, I wrote April to December with a question mark. What's happening now is laying the foundation for the rest of the year. Will it be a long-term crisis and an energy crisis, or will it pass in a reasonable time? And will we return to Goldilocks for the rest of the year? That's the big question everyone's asking.
So this is what we're going to brainstorm about today. Let's try to give it a little bit more structure and organization. And you touched on it. Let's take that first. AI technology has been a key driver for the stock market ever since ChatGPT launched in November 2022.
AI, right?
Is also geopolitics. And AI technology, as we know, is an ever-growing part of everything related to defense and warfare. And the investments in technology, especially data centers, are unprecedented. And you have a quite nice way to illustrate that. Yes.
I've got a graph that was I subscribe to something called Substack, where I'm a regular, where many good investors write and share information. There I found this figure in an article about AI. And what does it show? It shows the size of investments as a share of the gross domestic product in the US. And it starts in the 30s with these public programs launched during the Depression, the Hoover Dam, bridge building, major public infrastructure investments. That's the low yellow one there on the far left. So we see it was maybe 0.1 to 0.2% of GDP at that time. And then we have the Manhattan Project, atomic bombs, which was a very large project for the Americans. Look at the size of that. It's blue there. And then there's the introduction of electricity. That was over a longer period, 20 to 25 years, the size of that. Then we were going to the moon. What did Kennedy say? He had that famous quote there about how we should do it not because it was easy, but because it was hard. That was exactly why the Apollo project. Then there's the expansion of highways in the US. Then coming to more recent times, what everyone thinks of is the TMT bubble in the year 2000, the size of that. And then you see the size of the investment within the technology sector last year and what's coming this year in the black column. To the far right there, it says that if I add up all the investments as a share of GDP from the Hoover Dam to the Manhattan Project, the Apollo Project, and the highway construction, it's roughly equivalent to the size of these new investments. So that says something about the scale of this means many investors are thinking the following: how much money will I make on this? Because such a heavy bet has been placed on it now. So that's one question in the market. The other question is, if it becomes as big as we believe, / fear, depending on where you stand in the debate, who will be the winners and losers? And then I had a figure on the next page where I just show what has happened in the market over the past year. The solid black line here represents global technology stocks, meaning there are many American stocks and then many Asian stocks, as those are the major technology regions. And these are linked to each other. You can see that the supply chains for American tech companies are in Asia, in Korea, and China. And you see that it's been basically flat since October of last year. While you see that those who produce the chips used to train AI models, that's the light green one at the top. That one has raced further upwards, while software companies are collapsing. So that was really the story at the start of the year before this happened in the Middle East, the disruption happening within the tech market and who will be the winner. And we've seen part of that on the Oslo Stock Exchange. And we have some companies like Venn that have taken a beating because of this. That was the story. It's still a story in the market, and I believe it will continue to be with us. The market sometimes has difficulty holding two thoughts at once because what's happening in the Middle East is so essential.
Absolutely.
Then that is exactly what ultimately trumps the attention, you know?
Before we move on from that, because I find this very interesting, we've also seen that if you look at the expected capex for 2026 and 2027 from these hyperscalers, it now accounts for more than 40% of the expected capex on the S&P 500. So that's quite intense. And at the same time, global AI computing power
It
is now doubling every 7 months, which means it's accelerating at an incredibly fast, almost breakneck pace. And interestingly, demand is still
greater
than before supply. So you have a positive underlying driver there as well.
Yes, perhaps.
And then there are many, maybe
Because what's interesting is that when you say computing power doubles, you see capex increasing. That means every doubling becomes more and more expensive. So there are also some who argue that AI is about to hit a ceiling in terms of how expensive it becomes to take it one step further. So that's also a debate within this
topic.
In the end, someone has to make money on this. As an investor, you live on getting money back in the form of a cash flow that comes as a payout, dividends, or reinvested in something else. For now, this is just expenditure and a bet on something that will become very big. So that's the final question. Who will profit from this and how much profit will there be? Or is it that we get a lot of utility from AI without those who invested so heavily getting much benefit? That was the story from the dot-com bubble, and that's the uncertainty
in it. I'd like to talk more about this, but we've promised to cover the Middle East, but generally being a bit of a tech optimist, having tech exposure in your portfolio and not underestimating the USA. That's something one should always keep in mind. And then we know that energy is the biggest bottleneck for AI specifically. And in the Middle East, we also see that helium exports, for example, are being limited, which we know goes east to these big AI companies there, like Taiwan Semiconductor. But then we know perhaps in the longer term, if this in the Middle East continues, it might limit access to capital for technology in one way or another way. And that would perhaps be even worse. But okay, take us further to the Middle East. Yes, I will
do that. I'll just add one last comment on this because it also illustrates how difficult it is to navigate this space. I'm very glad that when we invest in technology, we invest in the DNB Technology Fund, where teams sit and pick the companies that are doing well. I think that's extremely important. We
have some of the best in the world to manage this.
So that makes me sleep a little better at night when we have money there. Okay, so then it is, as many people have surely read up on or heard about, a very central and extremely important area for the world's energy supplies. So to put it into perspective, roughly a fifth of the world's oil and gas resources actually go out of that area, supplying not only Europe and Asia, but mostly Asia in particular. What has been a bit new and somewhat surprising for me in this whole situation is really understanding just how central and crucial they are in connection with fertilizer production, and also realizing how central and significant that is, not just for one region, but for the world as a whole. It is in a critical phase now, where we will eventually start to, and so it has consequences for food production. And what we know from before is that when food production has failed, we get higher price increases, and especially in Asia as well. So we in Europe are hit by this, but we have the opportunity to import more gas from the USA. But especially for Asia and what we call emerging markets, this is critical, exactly what is happening, and that the supply is not throttled for too long. Because we can manage for a period, now oil is being released from storage. So after this crisis in 73, 74, the last time there was a major war, the International Energy Agency was established, and they started saying that all countries must have like 3 months or 4 months of oil reserves, right? So we have that. But we don't have those reserves of fertilizer, and we don't have those reserves of byproducts related to oil. So now factories have started closing down in Japan, which need plastic components for further production. And you see that the rickshaws in Sri Lanka have to be pushed, and they aren't being driven. So we see now that we are in a critical phase. This cannot last another month before it has significant consequences for the world economy.
It becomes more critical with each passing day. And there are so many moving parts that there's probably no one here who has an overview of what the second and third round effects will be felt further out over time, impacting various different sectors of the economy. So
that's when we're in the paradox. And when we speculate on what we think will happen going forward, it's always good to keep in mind that since this is so important to so many, we can assume many are working behind the scenes to try and de-escalate the situation. We can at least assume that. And that's a word of comfort in this situation. Even if it looks a bit dark right now regarding what you started the day with, not starting with the escalation. But at the same time, if we're to put this in perspective relative to the oil crisis we had in the 70s, we can look at the oil price. So what I've done here is that $1 today is not the same as $1 40 years ago. You could buy more for $1 40 years ago than today. So when I like to look at the oil price, I like to look at the oil price in fixed prices. That is to say, we actually have to adjust the historical oil price for purchasing power, which was higher for $1 in the old days. So the black line is a purchasing power adjusted oil price. And then we see that during the oil crisis in 73 and 74, prices were extremely high. Higher than they are at today's level. We see that just before the financial crisis and just after the financial crisis, we had a period of higher prices than we have today. And during the invasion of Ukraine, prices were also significantly higher than they are today, but prices are pointing straight up and the trend isn't good, right? Because they're rising further. And then there's the question, how important is oil for the economy? And then you can take oil production and consumption, multiply by the oil price, and divide by the economy. That is the gross domestic product. Then you get a fraction that tells you how much oil intensity there is in the economy. And that's the red line. And where we see the historical average, historically oil output has accounted for about 4% as an input factor in the global economy. Now we're below 4%, which means we have a less oil-intensive economy today, which is a function of what we consume and the price of it. And we see that it has fallen throughout the 2000s. That's because we've electrified the economy, we've got electric cars, oil as an energy source is less important than it was before. In Europe, oil consumption has fallen year after year after year. That's a good thing. So that means that when the oil price goes up now, it's not as strong a shock to the economy as it was in 1973 and 1974, when the king took the tram up to Nordmarka to go skiing. So there's some good news in that. But it also tells us that we're close to a tipping point, right? If the oil price were to rise above $120 a barrel and stay high, then the cost to the economy will go from 3% and closer to 5 and maybe 6. And then we're at the levels where we think it's critical. What will happen then is that demand will fall and we'll get a much weaker economic situation. So the critical thing is the level of the oil price and time to get that effect. So we just have to monitor this. The hope is, of course, that it doesn't last long, right? Because then the damage won't be permanent. Then this comes down again. And then we get the inventories filled up again, and then we're good to go again. Or if this lasts longer, the consequence will be much greater. And we have some thoughts about that, but I must emphasize that it's impossible to know for sure exactly where we stand today. So then the question is, how do you handle such a situation? So you
can now share your thoughts on that, and then everyone watching and listening to this should keep in mind that ultimately you have to make up your own mind here about what you believe and what risk you're willing to take in the situation you're in now. Yes.
And for savings, we'll share some of what has traditionally been wise to do, how one should respond to such things. If we look at market movements just in the stock market, the black line here is the global stock market. That's all global stock markets. That's Europe, the United States, Asia, and emerging markets. And there we see that so far the market has sold off, but we're nowhere near the dip we saw in April last year, when Trump came out with the stone tablets and new tariffs and customs rates and all that. So we've had a correction in the stock market, but so far it hasn't been very, very large. What
is it? Europe down 7.5% from the peak. The United States down 5%-ish from the peak.
Emerging at this moment.
Markets, which have risen a great deal leading into this, are falling a bit more. But then you're back to the point where what has risen the most also gets the most downward momentum. But it's still not, as you say, it's not panic. There's
no panic in the market. There isn't, because people think it will pass. That's the base case in all of this. And this shows it. The light green one here is emerging markets, as you mentioned. And you see it had a rocket-like rise from November last year relative to global stocks. And now it's come down. That's perhaps not surprising given that they are most exposed energy-wise to what's happening. And then you have Norwegian stocks doing very well. And this is a bit, because usually if you say the world is becoming a slightly worse place, the Oslo Stock Exchange doesn't tend to do very well. But this is a unique crisis that is making the Oslo Stock Exchange do well. In our mandates, we always have a portion of Norwegian stocks. Normally that should be around 1/5. Now we have somewhat more, and that has slowed the fall. So you could say that rule number one when it comes to investing is to be diversified, because you never quite know what will hit you. And now you see the benefit of that, right? You've been fond of technology, Marius, and investing in it and those themes, but it's been nice to have the good old Oslo Stock Exchange and commodity heavy stocks in this phase. And I'm
not saying that one shouldn't have
Oslo Stock Exchange, but it just illustrates the picture here. And then the question is, if we were to speculate on where we're headed, there are several outcomes to what could happen. We've tried to set up 3 scenarios. I apologize if the headings we've used are perceived as a bit populist. And then we've tried to assign some probabilities. I must emphasize these are fluid depending on what happens, of course. But to start, you could say that if you set the following assumptions, that you believe the United States achieves its goal, which is regime change and installing people to lead Iran who are US friendly, and in that way gain control over oil production as they have seemingly gained control over oil production in Venezuela. two important suppliers of oil to China. That's interesting. It's one way to read this situation as to why the US is doing this. If that happens, the oil price will likely fall back down quite quickly. Then one should consider whether to still have as many Norwegian stocks versus global ones, if that were to happen, given that Norway has done so well. Because then we think we'll be in a world the US has won. We're in a world today with a kind of new Cold War and two opposing poles with the US and China. If the US manages to push through its will here, they establish that the US is still the biggest boy in school on the playground and we're in charge. And then they confirm their hegemony. That's going to be positive for the US. It's going to be a political win for them, a strategic win. And that means that fear around national debt, maybe it will subside. Investing in the US becomes even more attractive, and we think that's a very positive US scenario. We've said there's a 1/5 chance of that. And here one can certainly disagree. And then we go to the other tail. The two to the left and right I'd call a kind of tail risk. Those are outcomes that aren't the central case currently priced into the market. The other is that it goes as it has gone other times when regime change has been attempted in the Middle East. Think Iraq, think Afghanistan, and so on and so forth. Further, it's that one underestimates how difficult it is to achieve. One underestimates how much resistance the established regime can put up and how low-tech solutions can be difficult to defeat. I mean, you can do that. You don't need ballistic missiles to be a threat. 4 men in a jeep with bombs and explosives can also be a threat to infrastructure, and that means in that case that the war will escalate and it will spread. That's sort of what's unfavorable about what's happening now, as you mentioned this morning. This is indeed a sign of that. And then other countries are drawn in. And then this energy supply is very critical for Asia, including China. What will they do eventually? More question marks are appearing. And then you're in a bit of a nasty situation. And then you're in a situation where the US might have to consider deploying ground troops. Now, there are some Marines on the way, but there aren't very many. So it's nowhere near the buildup you'd need if you were to, in a way, go into Iran. So we're not at... So this is the probability we think is lowest for that, but it would be the most unfavorable case. Then we get an energy crisis, then oil prices stay high for longer, then we get a drop in demand in the global economy. The right thing to do then is to own fewer stocks and have more in cash. That was the story from the 70s. So
those are the two
extreme scenarios.
And then there's the main scenario, which I suppose is also what's still the market consensus. Exactly.
Right, so
walk us through it.
I'd say so, and we've called it TACO again, and TACO is the acronym, right, for Trump always chickens out. And that's because Trump is Trump. He might just decide to stand up on a stage and say that I've won. I've bombed everything I had to bomb. I might come back in a year or two, but now we're done and now we're leaving. Then the acts of war will de-escalate in the situation. What we don't know is how the relationship between Iran and its neighbors will be after they leave. So there's still some uncertainty around that. But you can imagine a situation where you remove quite a bit of the fear of ending up in the scenario on the right, and that it will end up with a kind of risk premium in the oil price, which could be beneficial for oil and gas companies, but it doesn't go so high that it kills demand. And then we think that Trump has said, and it's important to remember that these dynamics are always shifting, so the outcome is not set in stone. 1. In real terms, the Americans have lost because they've tried to achieve something they haven't managed. So strategically, it's a loss for the US, a victory for China. And then we think we're more in that world where we should buy the risk. For me, that means buying more stocks and that we should invest more outside the US in things like emerging markets and Europe. Then we're back to where we were at the start of the year. So those are the 3 scenarios that we have, and we still believe most, as mentioned, in the central one. So we are where the market is. And we see that when we look at market prices, as you say, there hasn't been a major drop, and futures curves and things like that don't show any panic. But in the background here, this is what's happening. And I think this image is quite illustrative for us because I graduated high school in the 90s. The wall fell. We lived in a world dominated by the US. Now China is on the rise, and we're in a situation where there's friction. I think that's going to affect us in many areas. The question is, what do we learn from this? I'm just thinking about what's happening in the world today. If you're a politician in Europe, for example, and you see what's happening, wouldn't you then speed up the process of trying to build up nuclear power, for instance, establish energy independence, invest more in the defense sector, blah, 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 and so on? So I think this is an interesting investment theme. We have invested in those themes, but it could well be that we should invest even more. more in those themes going forward. So that's something we can take away from this, from what's happening now. And last but not least, it's good to remind ourselves of this figure here. Interesting figure. It's the stock market from 1700 until today. So we have one of the first bubbles we know of in 1720, when Isaac Newton lost a lot of his money because he had fear of missing out. He was in that bubble there, South Sea bubble. And the reason I'm showing this figure is what we're discussing now, because most investors learned that in 95 out of 100 cases, it's best to do nothing and stay calm. It could well be that that's the smartest thing to do here now. That's what this figure shows. The trend in this figure is unmistakable. It's upward to the right. So the stock market delivers returns over time. So avoid being too dominated by the news that's out now. If you feel uncomfortable, you can of course reduce your risk. But most likely, the best thing is probably to sit through it. I think that's the right conclusion. What have we done? We've increased our investment slightly towards the Oslo Stock Exchange and Norwegian stocks. We have a mandate to make those adjustments, and we own slightly fewer stocks now than we normally do. So that's, in short, how we assess the situation.
Very good, Tor. I've been sitting here itching to jump in with lots of things all the time, but we're a bit pressed for time today because we have to wrap up now. But we're also going to release this as this week's podcast in the Utbyttepodden. So when we turn off the lights here, I'm going to keep you back, and then we'll discuss a bit more, and then we'll try to answer some of the questions that have come in. So for those of you who want even more, you can tune in to the Utbyttepodden starting this Friday, March 20th, folks. Now we're wrapping up. Thanks for watching, and see you again.